What if what we're seeing in the US stock market, these euphoric highs and record-breaking rallies, is actually the setup for something far more complex and far more dangerous? Let me ask you this. If an economy is showing warning signs of a recession, yet the stock market keeps climbing, are you bullish or are you nervous? Sound off in the comments. Do you think the US is actually heading toward a recession? Yes or no? Because today on Endgame Compass, we're diving deep into a situation filled with contradictions. We'll break down why US economic indicators are sliding, but equities keep rocketing upward. Why the current earnings season didn't give us clarity, gave us chaos. One major economic risk you need to watch. One rare opportunity that could define second-half performance in 2025. Stick with us to the end. Because hidden within the chaos is a roadmap, a clear investment logic that not only explains these contradictions, but helps reveal where risk and reward truly lie as we head into the second half of the year. Let's start with the elephant in the room. The US economy is staggering under the weight of accumulating soft data. Over the last several weeks, we've seen economic reports arrive sharply below expectations. Major investment banks and financial institutions, from Goldman Sachs to Morgan Stanley, are rapidly revising their growth forecasts downward. It feels like something is unraveling quietly beneath the surface. But the stock market? A very different story. Indexes like the S&P 500 and NASDAQ keep punching toward all-time highs. Hot stocks bounce 10, 15, even 25% in a matter of days. If you're in the markets right now, you might feel that dizzying tension, what investors often call the air is thin up here. There's a real case to be made. The higher we go, the more fragile things feel. This divergence between economic reality and market euphoria is why we're tackling this story today. Because behind this contradictory backdrop, there's actually a very clear investment logic once you understand it. You're no longer reacting to headlines. You're navigating with confidence. Let's begin with what triggered the latest batch of recession fears. Recession warnings aren't just coming from skeptical commentators anymore. They're coming from institutions. Moody's recently warned that the US economy may be at the edge of a recession. Bank of America increased the chance of a downturn to 60%. And last Friday, the broader market dropped sharply, signaling that institutional investors are finally reacting to these growing concerns. But the spark came from a jobs report that was anything but ordinary. In July's non-farm payroll report, the U.S. added only 73,000 jobs, well below the forecast of 104,000, and when you dig into where those jobs came from, nearly all of the gains were concentrated in healthcare, a sector that, while essential, is largely immune to economic cycles. In simple terms, job creation in economically sensitive sectors like manufacturing, logistics, and retail fell flat. Then came the real alarm bell: revisions. May's job growth was revised down from 147,000 all the way to 19,000. June's figures slashed from 125,000 to just 14,000. In other words, what looked like modest growth was actually stagnation. Whenever we've seen this pattern of downward revisions in history, it's been a leading indicator of recession or, at the very least, extreme economic stress. But here's the twist. Other data points are telling a very different story. If the labor market was truly on the brink, we'd expect unemployment numbers to rise and layoffs to spike. That hasn't happened. Unemployment in July remained historically low at 4.2%. Weekly unemployment claims, an even more responsive indicator, have actually trended downward for 2 straight months. That tells us something fundamental. Employers aren't panicking. They may be slowing hiring, but they're not cutting workers loose. Even within manufacturing, which is usually the first to crack in a downturn, we're not seeing mass layoffs. In fact, profitability in the sector remains elevated. Why? One explanation is the uncertainty created by U.S. trade policy over the summer. Companies were facing unpredictable tariff negotiations and may have simply paused new hires, waiting to see how things play out. So while new job additions are slowing, there's no sign of mass weakness yet. And that's only one part of the picture. Consumer spending, which makes up roughly 70% of U.S. GDP, remains robust. Bank of America and J.P. Morgan reported credit card spending growth of 4% and 9%, respectively. Retail juggernauts like McDonald's and Walmart showed surprisingly strong earnings. Loan default rates are falling across the board with the exception of student loans, largely due to the resumption of payments, not an indication of fiscal stress elsewhere. Consumers, in short, are still spending confidently. So does this mean there's no threat at all? Not quite. Let's talk about two key warning lights still flashing on the dashboard. The Purchasing Managers Index, the PMIs, one of our best forward-looking indicators for economic momentum. And here, the data is not reassuring. Manufacturing PMI has continued to decline steeply and is now below the 50 mark, signaling contraction. Services PMI, while still above 50, has been creeping downward. Add to that a growing concern over delayed inflation effects. Tariffs imposed earlier this year didn't cause immediate inflation. Instead, most companies stockpiled inventory, buying time. But now those inventories are running low. As of August 7th, the U.S. imposed another wave of punitive tariffs on over 90 countries. Financial analysts, including Morgan Stanley, project that by August, the core PCE personal consumption expenditures inflation rate could jump to 0.4% month over month and stay elevated for several more months. This is a real risk. Rising prices, stagnant hiring, sluggish PMI, all converging at a very sensitive market moment. So what does it mean for recession risks? In our analysis, this situation suggests a weak, strained economy, but not one facing imminent collapse. Despite the stress signals, we're not convinced the U.S. economy is tipping into recession just yet. Here's why. Tariff-related inflation is a one-time shock, not a self-perpetuating cycle. Even Fed Chair Jerome Powell has stated publicly that tariffs don't create sustained structural inflation. Even if inflation spikes modestly in the short term, it's unlikely the Federal Reserve will tighten policy as a result. Meanwhile, the policy tools are still in place. If economic growth slows further, the Fed could dial back quantitative tightening or even cut rates. And don't forget the incoming Big American Growth Act. A new stimulus package built around tax relief and deregulation could provide meaningful tailwinds by year winds. So we still see runway for the economy to absorb shocks and reaccelerate. But that doesn't mean the stock market is immune from turbulence. If you're still watching, you're clearly here for insight that runs deeper than headlines. Subscribe to Endgame Compass and turn on your notifications. We decode complex market dynamics into actionable insights, and in a year like this one, getting the timing right could make all the difference. Even with our longer-term optimism, we can't ignore that markets are vulnerable in the next few weeks or months. There's always a lag between policy implementation and economic relief. But inflation updates, jobs data, those hit fast and they make investors nervous. In an overheated market like this, even solid news can trigger sell-offs if it falls short of exaggerated expectations. We wouldn't be surprised to see a temporary correction in the 5 to 10% range. But here's the key: it would likely have little to do with fundamentals, and that dip. This could be one of the most attractive entry points we'll see this year. The question isn't how to avoid the storm, it's how to position yourself when the clouds clear. Earnings season has exposed something remarkable. A surge of outperformance entirely concentrated in companies deploying AIs, and P500 companies posted year-over-year earnings growth at 11.8%. More than double consensus expectations of 5%. What's driving this? Not government stimulus, not monetary easing. It's the monetization of artificial intelligence. Let's look at examples. Microsoft's Azure Cloud unit posted growth highs not seen in 5 years, despite now being a $30 billion business. Meta used AI to turbocharge ad performance, leading to a 22% revenue spike. Palantir's AI-driven commercial operations surged 93%. With executives projecting 10x revenue growth within 5 years, Shopify's AI enhancements cut onboarding costs and boosted repeat consumer conversions sharply. Post-earnings, up 20%. Duolingo saw a 41% earnings jump, directly tied to AI-driven user engagement models. The pattern is clear: companies using AI to meaningfully improve profit margins or top-line growth are being aggressively rewarded. In fact, the earnings season looked like fireworks. Companies integrating AI popped like rockets. Those without it, they fizzled. Industries still relying on legacy processes or lines, toy makers, apparel brands struggled across the board. Even among tech giants, those with less AI emphasis like Apple, Amazon, and Tesla underperformed peers. It's also worth pointing out, missed expectations were punished far more harshly than usual. The average stock that missed this quarter dropped 5.6%, more than double the 5-year average drop of 2.4%. So the playbook is shifting. In this market, performance matters. Hype isn't enough. AI execution is becoming the new benchmark. Despite all the noise, here's what truly matters. Enterprise AI adoption is still under 10% in the US, according to Goldman Sachs. Even among large corporations, AI usage hasn't exceeded 14%. That tells us AI is still in the first inning. And as costs fall and tools become more accessible, growth here could accelerate faster than any previous digital transformation. Economic risk, inflation, stress. Those are real, but they're unlikely to outweigh the profit potential unleashed by smart AI integration. That's why we remain bullish long-term. The AI-powered rally may still be in its early stages. The market is facing a short-term squeeze from rising inflation, potentially triggering a 5 to 10% pullback. But keep in mind, that's within normal volatility in a broader uptrend. On the other hand, AI is already reshaping profitability and will continue to drive stock performance. So here's how we're positioning. Stay invested in AI-centric companies, especially those in the application layer, just the infrastructure plays. Look to AI-enabled companies in economically sensitive industries. They're undervalued today, but uniquely positioned to lead the next rebound. Think Tesla, Meta, Amazon, their AI-driven segments offer powerful upside. Don't overreact to short-term dips. Use them to build positions, not panic. This is a market that rewards clarity and punishes hesitation. I want to hear from your short-term inflation worries actually masking a long-term AI surge. Or is the market ignoring obvious red flags? Let us know in the comments. If you found this breakdown valuable, don't just click to follow Endgame Compass and hit the bell. Because in this market, execution matters, timing matters, and most of all, logic matters. We'll see you in the next one.